Hello, this is Dr. Karen Nunez, and this is the Chapter 6 lecture on inventories. Our focus in Chapter 6 is on reporting inventory in the financial statements. Inventory is reported on the balance sheet, the ending inventory, and the cost of goods sold is reported on the income statement. So when we sell our goods, there's a cost associated with the revenue that we report on the income statement. That cost is called the cost of goods sold. And then the ending inventory is the value of the inventory that remains at the end of the period that gets reported on the balance sheet. So typically, a physical inventory or a count of the inventory should be taken near the year end or the end of the period to make sure that the quantity of inventory that is reported in the financial statements is accurate. And after this quantity is determined, we need a cost for that inventory. That physical enables us to determine what needs to be reported on the balance sheet, the financial statements, as well as on the income statement. The problem that we are faced, though, in accounting for our inventory is when identical units of merchandise are acquired at different unit costs during a period. That happens when prices are changing, right? You buy goods at one price, at the beginning of the period, and then a week later you buy the same goods and the cost is different. The problem is when you're trying to determine the cost of the ending inventory or the cost of goods sold, what cost should you use? Which costs? The cost from beginning of the period or the end of the period or the middle of the period? How do you determine the cost that should be assigned? So we have to make an assumption, and we call that the cost flow assumption. So this cost flow assumption is what we use to determine the appropriate cost that should be assigned. Let's look at an example. So in this case, we have three identical units of merchandise, and they're purchased in the month of May at three different times. On May 10th, we buy one unit that costs $9. On May 18th, we buy one unit that is identical to the first unit, and it costs $13. And then on May 24th, we buy a third unit, and all three units are identical, and it costs $14. So the problem that we have here is that we've got three different costs. Now, if we average them, then on average they cost $12, but each unit has a different cost. So when we sell a unit, if we assume that we sell one unit, well, what cost goes into the cost of goods sold? Is it $9, $13, or $14? It has an effect on our financial statements. So continuing this example, if we assume that the May 10th unit is the unit we sold, then the cost of goods sold would be $9. And our gross profit or preliminary measure of income would be $11. And the cost of the ending inventory would be the two remaining units, the $13 and the $14, or $27. But if instead we assumed that the cost of the unit sold was the $13, then the gross profit would only be $7. And our ending inventory would be the 9 and the 14, or $23. And then lastly, we could assume that the unit we sold should be assigned a $14 cost. But then the gross profit would drop down to $6, and the ending inventory would be the $9 and the $13, or the $22. So with just this simple example and only three units, you can see our income, our preliminary measure of income, this gross profit could be $6 or it could be $11. So imagine if you were selling thousands or millions of units. Well, that could have an impact on your profit and also an impact on your ending inventory. The ending inventory goes from $22 to $27. It makes a difference. So we have to make an assumption about which costs we're going to assign, because whatever we choose, we have to do it consistently. We can't use one unit costs one month and then the next month do something entirely different. We've got to make an assumption about how to cost our units and then use that assumption consistently from period to period. It's called the consistency principle. It's a generally accepted accounting principle. So there are three assumptions that we're going to look at in this chapter. Now, there are more in practice, but in this chapter, we're only going to focus on three cost flow assumptions. The first assumption is what we call the first in, first out assumption, or better known as FIFO. That means that we assume that the first costs in to our inventory are the first costs out to cost of goods sold. And we'll look at an example in a little bit. The next assumption is last in, first out, or better known as LIFO. That means we're going to assume that the last costs in will be the first ones out to cost of goods sold. And then lastly is the weighted average. We're just going to average all the costs together and use one average cost for everything. Now let's look quickly at an example. In this example, continuing with the three units, right? We've purchased 3 units. May 10th for $9, 1 unit. May 18th for $1, 1 unit for $13. May 24th, 1 unit at $14. If we were using the FIFO method, first in, first out to cost of goods sold, then the first cost in to inventory is the first one out to cost of goods sold. And the last ones would be in the ending inventory. That's how FIFO works. FIFO, first in, is the first out to cost of goods sold, and the last ones are in the ending inventory. LIFO is just the opposite. LIFO is the last ones in are the first ones out. So in this case, it's the $14 cost that goes to our cost of goods sold. Last one in, first one out to cost of goods sold. That's LIFO. And so the first ones are going to be in the ending inventory, the 9 and the 13. So FIFO, the first costs in, are the first ones out to cost of goods sold. And the last ones are in the ending inventory. LIFO, the last ones in are the first ones out to cost of goods sold. And the first ones are going to be in that ending inventory. And weighted average, well, we're just going to average them all together. Just take the 9, the 13, the 14, divide by 3. Our average cost is $12. So that's the cost of 1 unit out to cost of goods sold. That's the cost of 2 units that remain in the ending inventory. And those are the 3 methods that we're going to use to determine a cost for the units in cost of goods sold and a cost for the units in the ending inventory. And we'll look at a few extended examples in the homework assignment. So when we report inventory, essentially cost is the primary basis that we use. So when you see the inventory reported in the current asset section of the balance sheet, typically we are reporting inventory at cost. But sometimes we might value it at something other than cost. The only time we do that is when there are problems that necessitate us in using a value other than cost. And here's where we're going to talk about a method that is called the lower of cost or market. If there's a decline in the market value, then we want to recognize that. We don't want to report our inventory at inflated numbers. So the lower of cost or market method, LCM, that means that if the market value is lower than the purchase cost, lower than FIFO, LIFO, or weighted average, right? Whatever cost you use, if the actual market value is lower than that FIFO cost, or lower than the LIFO cost, or lower than the average cost, then we would use the market value. So lower of cost or market means we're going to report our inventory on the balance sheet at the lower of the two. And market value is typically what we call the net realizable value. It's just what you could sell it at minus the cost to dispose of it, the cost to actually sell it. So looking at an example here, Let's assume that we have some inventory that has an original cost of $1,000. That's what we paid for it, right? And so that could be determined either using FIFO, LIFO, or weighted average. But we could sell it for only 800. So the price has declined to 800. It cost us 1,000. We could only sell it for 800, and we've got some selling expenses of $150. So essentially, the market value of this inventory is only 650. We've got something that has a cost of $1,000, but we can only sell it for 650. So that means that when we report this inventory on our balance sheet in the current asset section at the end of the period, we're going to report at LCM at the lower of cost or market. The lower of cost or market. Well, the cost is 1,000, market's only 650. We're going to be reporting it at its market value, the lower of the two, at 650. Okay. So that's how the LCM method works. And in fact, we could apply this LCM method to each item in our inventory. We could apply it to major classes or major categories of inventory, or we could just apply it to inventory as a whole. And in this following example, I'll actually show you how it works when you look at all three of those options. So in this case, using LCM, and we're going to apply it to individual items. So we've got 4 items here. We have the quantity, and the quantity times the cost gives us the total cost for each item, right? And we have the market value for each item. So the quantity times the market value gives us the total market value for each item. And when we apply LCM, well, the lower of the two, well, these 400 units should be reported at 3,800 because that's the lower number. The 120 units, though, of Foxtrot should be reported at 2,700 because that's the lower of cost or market. So we report that item at cost. The Sierra item, well, the lower number is the market. So we're going to report that at market. And the Tango product has a lower cost number, we'll report it at cost. So you can see we've got some items that are reported at cost, some items that are reported at market, but the objective is to always choose the lower number. And then we add those numbers. This is the number that we report on the balance sheet for inventory. We've applied the LCM method to the individual items. Now, one of the alternatives is to apply by class. So assume we have 2 classes of inventory, class 1 and class 2. 2 products in class 1, 2 products in class 2. So now we look at the total cost for the class. So the total cost for these 2 products is 6,800. The total market for these two products in this class is 6,692. We go with the lower. The lower, excuse me, is the market value of the class 1 products. When we look at the class 2 products, well, now what we're saying is the lower of the cost or market for the 2 products in class 2 is the 8720, the cost. That's what we'll report it at. So class 1, we report at market. Class 2, we report at cost. And the sum of these two, this is what we report our inventory at, 15,412 on our balance sheet. And that's how we're going to apply the LCM method to the class, to each class, class 1 and class 2. And then the third option is just apply it to inventory in total. So we have the sum of all the costs for the 4 products here, 15,520. We have the sum of all the market values for the 4 products. And the lower of the two is the market of 15,407. So we report all the inventory at the market value of 15,472. Notice each one of these approaches gives you a different value to report your inventory at on the balance sheet. So you have to choose one and use it consistently. If you're going to apply this LCM, you're either going to do it by item, by class, or in total. And on the balance sheet, inventory is typically reported Again, at the lower of cost or market, where cost is determined via FIFO, LIFO, or weighted average, and market value is determined using, again, that net realizable value. And inventory is always reported in the current asset section. So you would typically see on the balance sheet, again, current assets, and then here's your inventory, merchandise inventory of 5409. And there's a note here that the inventory is determined using the LCM, lower of cost or market. That's it for our chapter 6 lecture. I'll see you for the problem solving session for chapter 6.